So we are going to start off now, and the topic that we are going to start off, it's the working capital management. Now let me just guide you that the working capital management is an important area of the financial management syllabus. Why? The reason being that when we talk about this working capital management, it is part and parcel of the section C, plus there could be a case OTQ for it, plus there could be multiple MCQs or OTQs in section A also. So from the perspective of the exam, this specific area, this specific topic has got a good weightage. You could say 20 mark, could say 25 mark, 30 mark, depending upon the examiner's circumstances. This specific area could have multiple questions that are being tested. Now, when we talk about the concept of working capital management, there is something that you need to understand, that when we talk about the capital for a business, when we talk about the capital for the business, there are generally two types of capital that a business needs. And what are those two types of capital? There is one thing which is called a long-term capital, and there is something which is termed as a short-term capital. Now what do you mean by this long-term or a short-term capital? So you do have an idea that when we talk about a business requiring a long-term capital, so you need money in order to purchase the non-current assets. You need money in order to purchase the machineries, equipments, etc., etc. That's the money that is needed for the long-term assets. And at times the business also needs money for the short term. What do you mean by needing the money for the short term? So you need the money for the day-to-day matters, for the day-to-day affairs of the business, which is paying out salaries, paying for the utilities, the daily expenses, etc., etc. That is something that you also need. So when we talk about this short-term need, so this short-term, the money that is required for the business to operate, the money that is required for a business to run and operate, this is generally considered to be the working capital. This is generally considered to be the working capital. So the money that you need in the short run, the money that you need for the short-term period, that is considered to be the working capital. When we talk about the concept of working capital, the working capital is defined as what? The working capital is defined as current assets less the current liabilities. Current assets less the current liability. Now when we talk about the current assets, when we talk about the current liability, let's have a bit of a discussion about this. So when you talk about the current assets, there could be multiple things that could constitute the current assets. What are the multiple things that could constitute the current assets? So you can have the cash, you can have your inventory, you can have the receivables. All of this could be considered as your current assets. Similarly, when we talk about the current liabilities, so the current liabilities could have multiple things, including the overdraft, including the payables. So these are the things that the current liabilities would possibly include. So generally when we talk about the working capital, the concept of working capital is your current assets minus the current liability. Your current assets minus the current liability is considered to be the working capital. Now, when we talk about the working capital management, there is something that you need to understand, which is the working capital management. The main objective of this working capital management is to strike a balance. Strike a balance between what? Strike a balance between the profitability and liquidity. Strike a balance between the profitability and liquidity. Now, what do you mean by striking a balance between profitability and liquidity? So let's try to understand this thing. When we talk about the concept of profitability, the concept of profitability is that when the business's profits goes up, when the business's profits goes up, that means you are talking about the enhancement of the profitability. And when we talk about the liquidity, the concept of liquidity is actually your ability to pay off the debts as they become due. So when we talk about the profitability, it's enhancing the profits of the business. And when we talk about liquidity, it's actually your ability to pay off the debts of the business as they become due. Now try to understand something. I'll give you an idea that where do you need to strike a balance. Let's say as an organization, you make credit sales. I repeat, as an organization, you make credit sales. Now when as an organization you make credit sales, so what actually happens is that making of the credit sales would mean what? When you make the credit sales as an organization, this means that these sales are going to enhance your profitability. Why? Because the more credit that you give, the more the customers buy from you, and more the customers buy from you, so ultimately the sales goes up. So basically what happens is that the giving of the credibility, when you provide the credit, ultimately you are actually able to boost up the profit. You are able to enhance the profit. That's what extending the credit means. But the problem that actually arises with respect to extending the credit is that your cash flow is stuck. Your cash flow is stuck. And when your cash flow is stuck, that means you are not able to make your suppliers payment on time. You are not able to make payment for your expenses on time. And if you are not able to make payment for the expenses and the suppliers on time, this is a reflection of poor liquidity. And ultimately what would happen is that if your cash flow cycle is not going to match, you might end up with a situation. I repeat, ultimately what's going to happen is that if your cash flow cycle is not going to match, then ultimately what would happen is that you would be reaching out a position, you'd be reaching out a situation where you would have to go for the bank overdraft. And the bank overdraft would ultimately mean what? The bank overdraft would ultimately mean that whatever the profitability that you wanted to increase is now going to be decreased, because now what is happening is that you have actually obtained the overdraft and you have to pay the interest on that overdraft. So when we talk about the working capital management is to strike a balance between profitability and liquidity. And when we say striking a balance between profitability and liquidity, what exactly do we mean by this? We actually mean that we have to make sure that we don't focus excessively on profitability of the business at the expense of liquidity. And at the same time, we have to make sure that in our basically need of staying liquid, we don't compromise our profitability. Like at times, if the market is such that you have to give the credit, so you have to give the credit. You just cannot stop the credit. The market needs credit, you have to give the credit. If the market is operating on cash sales, you go for cash sales. But generally, if the market is operating on credit sales, you got to give the credit, you got to extend the credit. Now, when we talk about the working capital management, there are few things that you should understand with respect to working capital management. And what are few things? Which is that with respect to the working capital management, there are few ratios that you should know. I repeat, there are few ratios that you should know. And what are those ratios that you should know? So the number one of them is the current ratio. The number one of them is the current ratio. Now when we talk about the current ratio, so we know what a current ratio is. The current ratio is simply a ratio which compares your organization's current assets with its current liabilities. A ratio that compares your organization's current assets with the current liability. Now, is there any ideal current ratio? The answer is no. It depends upon industry to industry. It depends upon company to company. So whatever industry that you are operating in, whatever company that you are operating in, that's what the current ratio is gonna actually be. So maybe let's say if you have got $2,000 worth of current assets and if you have got $1,000 worth of current liability, your current ratio is gonna be 2:1. Your current ratio is gonna be 2:1. Now what exactly do you mean by this 2:1 current ratio? So when we talk about the 2:1 current ratio, this would actually mean that we have got $2 of current asset to settle $1 of current liability. This would mean that you have got $2 of current asset to settle $1 of current liability. That's what the current ratio would actually mean. So you got to be calculating this current ratio under the different circumstances because it tells you the liquidity position of the entity. The second ratio that we go about calculating a lot is called the quick ratio. Now what exactly do we mean by quick ratio? So when we talk about the quick ratio is also termed as, I repeat, the quick ratio is also termed as your acid test ratio. What exactly do you mean by this quick ratio, which is also the acid test ratio? Try to understand this thing. So when we talk about the quick ratio, the formula for the quick ratio is your current asset minus the inventory divided by current liability. So I repeat, what exactly is the quick ratio going to be? The concept of quick ratio is going to be its current asset minus the inventory divided by the current liability. Means, for example, if you as an entity have got $2,000 worth of current assets, and let's say if out of those $2,000, $1,500 is the inventory, and the current liability that you have got is 1,000. So resultingly what happens is that the quick assets that you have to settle these liabilities is only 0.5:1. Is only gonna be 0.5:1. What does it mean? It means that you have got $0.5 of current assets to settle $1 of current liability. Now, is it a good ratio? The answer is it depends upon circumstances, it depends upon entity, it depends upon situation. That's what it is gonna be. So we now know that what is quick ratio? Quick ratio is another way of establishing the liquidity. It actually tells you how much quick assets do you have in order to settle $1 of the current liability, right? Now, then there is this third ratio, which is again an important ratio and is a recalling of the different things that we have done. So there is this again the working capital ratio. This is again the working capital, and you know what a working capital is. It's simply your current assets less the current liability. So when we actually, at times the examiner also asks you to calculate the net investment in working capital. How exactly are you going to do the calculation for net investment in working capital? It's going to be simply your current assets less the current liability. What is it going to be? It's simply going to be your current assets less the current liability. That's what the net working capital investment is going to be. Now, as we move forward, there are multiple other ratios that should be known to anyone who is preparing for the financial management, anyone who is actually dealing with the working capital. And what are they? They are the ratios which are pertaining to the receivables, payables, inventories. These are those ratios. Now let's try to understand what these ratios are. So the first one of them is your inventory holding period. And when we talk about the inventory holding period, the formula for the inventory holding period is like this. It is inventory divided by the cost of goods sold multiplied by 365. There could be a situation where the examiner may ask you to calculate the inventory holding period in terms of months. So what would happen is that you might do it multiplied by 12. At times the examiner might ask you to calculate in terms of weeks, so you would put in 52 over here. So when I say the inventory holding period, what does this inventory holding period actually tells us? The inventory holding period tells us the average time that is taken to sell inventory from the date of purchase. The average time that it takes to sell the inventory from the date of purchase, like if it is 40 days, so that means it takes 40 days to sell the inventory. If it is 50 days, that means it takes 50 days to sell the inventory. That's what the inventory holding period is all about. So there is this important ratio which is inventory holding period. Now, let's move a bit forward, and another important ratio that you should know and that is about the receivable collection period. What is it? It is about your receivable collection period. What is this receivable collection period? So if I talk about the receivable collection period is calculated like this. You get the receivable, you divide it by credit sales, and you multiply it with 365. Again, depending upon what exactly the examiner is asking you to do. If he is asking you to calculate in terms of months, you multiply it by 12. If he is asking you to calculate in terms of weeks, you multiply it by 52. Depending upon what the examiner is asking you, you're going to multiply it accordingly. Now, what does this receivable collection period tells you? So when we talk about the receivable collection period, this receivable collection period tells you the average time taken to, the average time which is taken to recover the amount from customers from the date of sale. So average time that is actually taken to recover the amount from the customers from the date of sale is going to be considered as your receivable collection period. Now at times what happens is that from the perspective of the exam, you are not being given credit sales and you're just being given the sales. So if you're not being given credit sales and if you're just being given the sales, so what are you going to do is that you're going to use the sales as you would assume the sales to be equal to your credit sales, right? If you're not being given information, you would have to go for the assumption. Then there is this third ratio, there is this another formula which is to understand the payable payment period. When we talk about the payable payment period, what is this payable payment period? The payable payment period is going to be your payable divided by credit purchase multiplied by 365. Again, what happens is that the 365 could be converted into 12, could be converted into 52 depending upon what is the need. Now if I talk about it, so let me just guide you something. At times what happens is that, I repeat, at times what happens is that you are not being given the purchases. So when you are not being given the purchases, what you do is that you use the cost of goods sold. I repeat, when you are not being given the purchases, so what you do is that you use the cost of goods sold for the calculation. So payable payment period, what is it actually going to tell you? The payable payment period is going to tell you the time taken to make payment to suppliers from the purchase date. The time taken to make the payment to the suppliers from the purchase date. So the time that you take to make the payment to the suppliers is going to be considered as your payable payment period. Again, the question mark is that what should be the strategy with respect to the receivable collection period, with respect to the payable payment period, with respect to the inventory holding period. So ideally speaking, what would happen is that you should remember this thing, that when we talk about the inventory holding period, the shorter it is, the better it is. When we talk about the inventory holding period, always remember, the shorter it is, the better it is. Why the shorter it is, better it is? The reason being that when you invest your money into the inventory, you should try to sell out the inventory as soon as possible, because when you delay the sale of the inventory, this would mean that the inventory is going to become obsolete. This would mean that there is going to be some defects into the inventory. It might actually get damaged, things like that. So ideally speaking, as an organization, what should you try to do? You should try to make sure that the shorter the inventory holding period, the better it is. Now similarly, when we talk about the receivable collection period, So again what happens is that the shorter the receivable collection period, the better it is. Because if you are extending credit to your customers, in order to meet the cash that is stuck up with the customer, you would probably be going here and there. So if you would be probably going here and there, so what is going to happen? You would probably be incurring the cost. You would probably end up paying the overdraft cost. So if you would probably end up paying the overdraft cost, there is no point in paying the overdraft cost. The reason being that you should try to make sure that you recover the money from your customers in time, instead of extending them unusual credit which might lead to the excessive cost. Lastly, the payable payment period. What should we try to do with respect to payable payment period? So when we talk about the payable payment period, so ideally as an organization, the payable payment period is, the longer it is, the better it is. I repeat, the longer it is, the better it is. Now when I talk about the concept of payable payment period, I am saying the longer it is, the better it is. But always better to negotiate it. Don't just extend the payable period on your own. Just negotiate with the suppliers. Just negotiate with the suppliers so that they extend you longer credit and you are able to pay after a certain period of time. Because the longer the credit that you get, it's an interest-free loan that is being extended to you. So it's always beneficial for the entity to have a longer payable period. Now, there is another very important calculation which is based on these different ratios that we have calculated. So when I talk about another calculation, this is called the calculation of cash operating cycle. What is it? It is the cash operating cycle. The name of the cash operating cycle, there is another name which is called working capital cycle. Now what is this cash operating cycle or the working capital cycle? So if I could just go about doing some calculations with respect to it, I would say that the cash operating or the working capital cycle is calculated like this. How do you calculate the cash operating cycle? You say the cash operating cycle is inventory days plus receivable days minus payable days. So I repeat, cash operating cycle is inventory days plus the receivable days minus the payable days. Now what do you mean by this? This actually means that let's say if you have got the inventory days to be 40 days, this means that the date you made the purchase, it took you 40 days to sell the inventory. Then the receivable days is 50 days, means you sold the goods, the customers took 50 days to make the payment. That means resultingly what happens is that 40 plus 50, your money is stuck up for 90 days. What happens is that your money is stuck up for 90 days. Now what happens is that we say the payable days, let's say this is 60 days. That means you did not pay to the supplier on time. The moment you purchase, you took 60 days to settle to the supplier. So now when you took 60 days to settle to the supplier, resultingly what is actually going to happen? Try to understand. Resultingly what is going to happen is that 40 plus 50 is 90 days. 90 minus 60, it gives you what? It gives you 30 days. 90 minus 60, what does it give you? It gives you 30 days. I repeat, 90 minus 60, what does it give you? It gives you 30 days. So what has actually happened? When we talk about the concept of this 30 days, this 30 days is actually reflecting what? This 30 days is reflecting the time taken to recover the $1 invested in working capital. So what have you done? You've invested the money in working capital. What's the money that you've invested? Whatever amount that you've invested that amount for 30 days. You are recovering your money in 30 days. So again, the shorter the working capital cycle, the better it is for the entity. The shorter the working capital cycle, the better it is for the entity. Why? Because that means you have to invest for the shorter period of time. When you have got a longer working capital cycle, that means you have to take credit for a longer period of time, and obviously you got to incur extra interest costs for that longer period of time. So when we talk about the working capital management, I have explained to you people that you got to focus upon the balance between profitability and liquidity. And when you have to strike a balance, you got to understand some different type of measures, and that I have discussed with you. Now, there are at times some other ratios also, and let me just guide you that as a student, when the examiner asks for those ratios, you just have to make sure that what you do is that you do the inverse calculation. Now, what are those ratios? Let me just guide you a bit. At times what happens is the examiner may ask you the inventory turnover, I repeat, what happens is that at times the examiner may actually ask you to calculate the inventory turnover ratio. Now, what exactly do you mean by this inventory turnover ratio? Let me just guide you people a bit. Inventory turnover ratio is opposite to the inventory turnover period. Now, what is this inventory turnover ratio? As we looked at the inventory holding period, it was inventory divided by COGS into 365. Now here the inventory turnover ratio is gonna be what? The inventory turnover ratio is gonna be COGS divided by inventory only. Now what is this reflecting? This is reflecting that, let's say for example, you have got 100,000 worth of the cost of goods sold, and the inventory that you have got is worth 20,000. So this inventory turnover ratio is be 5 times. What do you mean by 5 times? That means you have rolled over your inventory 5 times. You have rolled over your inventory 5 times. Means whatever inventory that you purchased, you sold it, then you purchased, then you sold it, then you purchased, then you sold it. So it has happened 5 times. The higher the inventory turnover, the better it is. Why? Because you are investing less amount in inventory and you're rolling it over again and again, again and again. So that's actually going to be helping you out. Now, before I proceed further, I would like to go about discussing some of the questions pertaining to this working capital management. I'm going to take you through those MCQs pertaining to the working capital management, and we would try to actually do these questions. So okay, probably moved a bit forward. Okay, here you go. So there are different questions. Obviously, I'm going to take you through the whole of it. But again, for the time being, I want to deliver the concepts. Plus, I want to do some practice also. So let me take you step by step. Now, the first thing is that we have got different MCQs, OTQs in front of us. We would try to do those OTQs, MCQs. The first one of them is, it says the following information has been calculated for D company. What is the requirement of this question? It says what is the length of the working capital cycle. You have to establish the length of the working capital cycle. Now you know this thing, the working capital cycle is what? The working capital cycle is inventory days plus the receivable days minus the payable days. That's what the working capital cycle is. So now, what have we got here? We have got receivable collection period, okay. We have got raw material inventory turnover period. We have got work in progress inventory turnover period. We have got payable, we have got finished good. Now, try to understand something. You purchased raw material. It got converted into WIP. then it got converted into finished good, and then it was sold. Now, so the moment you purchase the raw material, it took you 6 weeks to convert it into the WIP, and the moment you purchase the raw material, for 6 weeks it was raw material. Then what happened is that for the 2 weeks it was WIP, and then from WIP it stayed as finished good for 6 weeks. So resultingly what happens is that your raw material is stuck up for a period of what? 6 plus 6 plus 2, 14 weeks actually. Your raw material is stuck up for 14 weeks actually. So what are we going to do? We are going to say, okay, the inventory holding period is going to be 6 weeks, which is the raw material, plus 2 weeks, which is the WIP, plus 6 weeks, which is the finished good, plus 10 weeks, which is the receivable collection period, minus 7 weeks, which is about the payable period. So hence resultingly 6 plus 2 plus 6 plus 10 minus 7 gives you what? Gives you 17 weeks. So your working capital cycle is going to be 17 weeks. What is it going to be? It's going to be 17 weeks. Now let's move a bit forward. Let's try to understand the next one. It says a company sells inventory for cash. So what did you do? You sold inventory for cash to a customer at a selling price which is below the cost of the inventory items. You sold inventory less than cost. How will this transaction affect the current ratio and the quick ratio immediately after the transaction? Indicate by clicking in the relevant boxes. So you have got the boxes of increase and decrease. Now, let me just guide you that if you come across such a question, how exactly are you going to be answering this question? Let me just give you an idea. Just assume that you have got hypothetical numbers. Just say that current ratio, thus say the quick ratio. Let's say the current ratio is 1000 divided by 500. So you've got current ratio of 2. The quick ratio is 1000 minus 300 divided by 500. So you have got 1000 minus 300 divided by 500. You have got 1.4 as your quick ratio. So your current ratio is 2, your quick ratio is 1.4. Now let's try to understand something. What actually happens is that when we talk about this current ratio, the examiner is telling us you sold the inventory for cash and the inventory was sold at a value which was less than its cost. So let's take an example. You sold inventory that had a cost of 100 and you sold it for, let's say, 80. So what would be the impact on current ratio now? The current ratio would be you had a current assets of 1000. Out of 1000 you have lost inventory of 100, but if you have actually got a cash of 80, and then what happens is that 500 is your current liability. So you would say 1000 minus 100 plus 80 divided by 500 gives you 1.96 as the current ratio. So you could see the current ratio has what? The current ratio has decreased. I repeat, you could see the current ratio has what? The current ratio has decreased. Now, if I talk about the quick ratio, I would say it is going to be 1000 plus 80. Why would you say 1000 plus 80? In fact, wait a bit. 1000 minus 100 plus 80. This is your current asset minus, what you would do is that you would say inventory. How much was the inventory? It was 300 and now you have sold the inventory worth 100 divided by 500. So it would simply mean 1000 minus 100 plus 80 is 980 minus 200 divided by 500 this would mean 1.56. So your quick ratio is going to increase. Now, if somebody of you would say that, Mr. Lukman, how can we remember this? So I can actually tell you that you just cannot remember this. I would always suggest just take the hypothetical numbers in the examination and try to put in those hypothetical numbers and try to do the calculation. So the current ratio is going to decrease and the quick ratio is going to increase. The current ratio is going to decrease, the quick ratio is going to increase. Let's move a bit forward and let's talk about this 52. It says the cash operating cycle is equal to which of the following? So when I talk about the cash operating cycle equal to which of the following? Receivable days plus inventory holding period minus payable days. Yes, A is correct. Why is B incorrect? Because it's inventory holding minus. It's not minus. This is a wrong portion of the MCQ. It says receivable days plus inventory days plus payable days. It's not plus. Receivable days minus payable days, okay. Minus in, no, this is not right. So that's why A is correct. The next question, he says the company has annual credit sales of 27 million and the related cost of sale is $15 million. Company has the following targets for the next year: receivable days, inventory days, payables. Assume there are 360 days in a year. Now that's very important. Examiner has told you himself that you should assume 360 days in a year. So don't go on to assume 365 days in a year. It's 360, so that means 360. Now what are you actually going to do? You're going to say, okay, the receivable days so and so. So what is the net investment in working capital required for the next year? How would you know the working capital? Working capital is simply the current asset minus the current liability. So that means you would establish current asset, you would establish current liability. Try to understand this. You would say that the first thing is that we are going to do the receivable calculation. We know that for you to be able to calculate the receivable days, receivable divided by sales multiply by 360 is going to give you 50. So that means what is going to happen is that the receivable is X divided by the sales is 27 and then you multiply it with 360 is equivalent to 50. Just a minute, I'll just do it here. Therefore, the X is going to be what? X is going to be 3.75 million. So your receivable is going to be 3.75 million. What is it going to be? It's going to be 3.75 million. Now, similarly, let's move a bit forward and let's talk about the inventory days. So when you talk about the inventory days, so with respect to the inventory days, what are you going to use? You're going to use the cost of goods sold. You're going to say X, which is the inventory, divided by cost of goods sold, which is 15, multiply by 360 is equivalent to 60 days. So hence X is going to be what? $2.5 million. So your receivable is going to be 2.5 million. Sorry, the inventory is going to be 2.5 million. Now similarly, when we talk about the payable, it is going to be X divided by 15 multiply by 360. X divided by 15 multiply by 360 is equivalent to 45 days. Hence X is gonna be what? X is gonna be $1.875 million. So resultingly 3.75 plus 2.5 minus 1.875 gives you 4.375 million. That's what the answer is. So 4.375 million is going to be your net investment in the working capital. Okay, there is this another question, which is generally increasing the payable days suggest advantage is being taken of available credit, but there are risks involved. Obviously, when you are extending the credit period, so if the supplier has given you credit period, that's okay. But if he has not extended the period, then that's a risk. It says which of the following is unlikely to be one of the risks involved in increasing payable days. Okay, so it says that what is going to be the unlikely to be the risk? Losing supplier goodwill? Yes, you will lose supplier goodwill. The supplier would say, hello, you are delaying it a lot. We are not going to extend the credit to you in future. The supplier goodwill is going to be lost. Losing prompt payment discounts? Yes, if you delay, you will lose the prompt payment discount. Suppliers increasing the price to compensate? Yes. Lastly, customers bargaining power. The customers have nothing to do with what my relation is with the supplier. Why? Because my relation with customer is a separate relation. My relation with the supplier is a separate relation. So this is gonna be your answer, that the customer's bargaining power is the unlikely thing that is to happen. So what have we done now? We have actually discussed about the basic of working capital management, and I have explained to you people the concept of the working capital management. Now, the next step towards the working capital management is going to be that we shall take each one of receivable, inventory, cash and payables. So what are we going to do? We're going to take each one of the receivable, inventory, cash and the payables. We're going to talk about them one by one, and we would try to discuss that what could be the areas that could be there with respect to this receivable, inventory, cash, etc., etc., etc. So I hope till now you would have understood the concept of the working capital management, that what is the main purpose, what is the main idea behind it.